do have to plan accordingly for your exit, though. You have to determine who your future buyer is ahead of time and what are they or how are they taking out debt? What is their most likely level of, spread between rate and cap rate that they're willing to, adhere to or apply the purchase towards.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Lee Fjord is a multifamily syndicator based out of St. Louis, Missouri. He's the founder of Green Forest Capital. They do value-add multifamily assets in the Midwest and the Southeast. Lee, welcome to the show.
Sam, thank you. I'm really excited to, jump on the podcast and bring some value to your audience.
Rock and roll, man. This will be a good time. Lee, there are 3 questions I ask every guest who comes on the show in 90 seconds or less. Where did you start? Where are you now? How did you get there?
Started in the trenches as a property manager. I now am a full-time investor syndicator with 588 doors under my belt, roughly 5 deals. I have gone full cycle on a 38 unit that doubled in value in 30 months. And I got there by partnering with amazing folks who rely on me and my team to be able to execute the business plan with them and on their behalf.
I love it, man. That's fantastic. And you guys are exclusively focused on the multifamily market.
Absolutely. So I'm bread and butter, value add apartments in the Midwest and Southeast. That's what we do is workforce blue collar housing. We provide wonderful, clean, modern places for people to live and grow and become the best versions of themselves.
When you say workforce housing, it conjures in my mind a 1960s, 1970s build, Class C, C minus, needs a lot of work. Dispel that myth for me if you can, please. What is workforce housing to you?
So workforce and I consider it more blue collar housing, where it is, it's the place where the guy who changes your oil lives. It's where, his wife or fiance, who is the assistant manager at Applebee's, lives, where they, maybe they start a family, or maybe it's the place where your postal worker who is now, retired and living on fixed income lives out, the remainder of their years until they need, a place to go. So those are kind of the 2 major demographics that we provide housing for, are people that are eventually going to be homeowners and people who are no longer able to maintain or want to maintain a home. But aren't A-class people. They aren't granite countertops and stainless steel, appliances type folks. They're, regular, everyday people. Age, we generally focus on 1980s or newer. We try to buy newer assets because they carry with them a lot lower level of deferred maintenance, so on and so forth. So 1980s or newer generally is what we try to focus on.
What are you guys doing? I mean, the theme that all of us hear probably at every conference, every podcast we listen to, we hear workforce housing, or we hear the term affordable housing, which I don't even know how you define what affordable is, but I digress. Affordable housing, all these things. And it's like, how are you finding opportunity right now? Are you finding assets that pencil that then are able to meet the demographics needs that you guys serve? I guess I see a lot of garbage assets out there. How are you guys finding the right assets in today's market, being as competitive as it is? Finally get to my.
Let me tell you, my trash bin is full of garbage deals that I've just thrown. You look, you evaluate, you review, you toss. You look, you evaluate, you review, you underwrite, then you toss. Right. You look, you evaluate, you underwrite, you submit an offer, you toss. You look, you underwrite, you submit an offer, you get approved, then you do inspections, then you toss. I mean, it's a process, and it's a full-time job of, picking the needle out of the haystack, the right opportunity. We don't buy deals that don't work, or at least obviously everyone wants to say we do that, or you do your best to do that. But at the end of the day, we have some pretty stringent requirements on the type of asset that we're willing to acquire. I agree. There's a lot of people that did dumb deals over the course of the last couple of years. We focus on the bottom line on the debt. Focus on the type of debt that you're placing on the property, because at the end of the day, that's what's going to, you know, save or kill your deal at the end of the day. If you've got the wrong debt on, whether that be the rate or the terms or the horizon, if you didn't plan that out accordingly or properly, or you didn't execute your business plan perfectly to hit that, you might be in for some trouble. So yeah.
Absolutely. No, that's super insightful. Tell me about what you guys today is. Oh, we're recording this October 25th of 2022. So not sure exactly when this will go live, but for those of you who are listening, know that this is relevant as of today. So tell me, what are you guys seeing on debt terms right now, and how are you securing that in such a way that it makes sense to you?
Each deal is different, but and generally a different type of debt type is applied to each deal type. So what I will say is we don't do any form of bridge debt. We don't do non-recourse bridge debt that has a shorter term horizon on it. Historically, we do either longer term agency debt options, or we will do a bank debt where we literally put our name on the line, where we put our deposits on the line with the bank in order to negotiate better quality terms with that local lender, which not a lot of syndicators are willing to do, but we are on the right deals on the right size in the right areas. So bridge and bank is how we do it. Bank debt right now we're seeing in the mid to low sixes, so like 6.25, 6.5 is what I'm getting right now on bank debt quotes. And then on agency, it's slightly lower. We're in the high fives, on agency debt options, which, considering that literally in December a year ago, less than a year ago, we locked in a 10-year note at below 3.5. So from 3.5 to 5.75 is a big deal.
That's a really, really big deal. What has that done to your projections, if anything?
So we focus on the deal and what size of debt we can do. So if the proceeds on the loan are going to be, I don't know, let's call it 7.5 million, the most I'm going to be able to pay for that property is $10 million. Now the brokers right now, which I used to be one with a publicly traded company, right now they're trying to sell buyers on, oh no, it's just lower leverage. The property's still worth 12. You just can only get 7.5 in debt on it. So it's still a $12 million property, even though it doesn't qualify for the right amount of leverage. Or you can go get bridge debt. Good luck with that too. So no, prices are coming down. Sellers are realizing that the value of your asset and is based upon the amount of debt you can take on it. So it's literally, cap rates are directly correlated to debt cost. So yeah, those who are projecting 4.25, 4.5 cap rate exits now or next year are good luck to them.
Man, and this is a point of contention where I hear this argued both ways, and I don't know that anybody's necessarily 100% right, but I have to agree with you. I mean, it's like, it just doesn't make sense. I had somebody ship me a deal literally this morning, and it was just the buy cap rate was below the cost of, or I guess above the cost of debt, whichever you want to look at that.
Yeah.
It was like, wait, like, the day I buy this, I'm paying more for the debt than what this produces. Like, I don't care what the value add plan is. Like, now we're gambling. That's assuming I can go in, execute a value add plan, increase revenues, blah, 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 and then cover that note. Like, it's just not going to work. And I think there will be a reckoning. It's going to take a minute to use a term, but it's going to take a while for this to work out, where finally I think sellers are going, oh, I've been sitting on this for a long time and I can't seem to move it. Well, it's because you're asking too much for it. It just doesn't make sense.
Yeah. Well, you know who the last person is to find out how much the property's worth, right?
Who's that?
The seller.
Oh, man, I think that's painfully true. One thing I want to circle back on is your story of coming from the property management side of things. I've often wondered, and maybe that's the entrepreneur in me, but there's always a head scratch when I'm like, wait, you understand everything about this business. Why are you still on the property management side? Now, if that's the business they built, great. But a lot of times I see people working in property management and they know more about how to own and run a multifamily property than I would.
Oh yeah. Oh yeah. You learn in the field. That's where I learned.
Yeah. How did you then get the bug and say, wait, I want to, move over to the ownership side and not be in the employee slash property management side?
I was lucky enough to have someone come into my life who kind of brought me under their wing and told me, Lee, this is great what you're doing. You're learning all these skills, but what are you going to use them for? And it was like, and then it was, I don't know. And he goes, eventually you're going to own things. And I go, oh, okay, tell me what that's like. And he's like, well, I got started essentially, from the bottom where you were. And now, at the time, he was the guy who doesn't even have to bother posting about their plane on Instagram or Facebook because he doesn't care
Right.
what you think. He's got the place in Aspen and the place beachfront house in Malibu. And literally, he's one of those people that couldn't care less.
Right.
And that's who I would eventually want to be, is the guy who, couldn't really care less and learned from him. It was, you own things. That's how you, how you become wealthy, not by feeing things or building theoretically building a property management business, but you're just building another business. And what do you do with businesses?
You run them.
And you sell them.
Right.
And then you take that money, go buy things with it.
Right.
So then you own it. So the only reason why you go vertically integrated is to sell the business. And he who builds a vertically integrated business in order to make sure it's done right or whatever, it's like, no. You're still doing it wrong. You build a business to sell, just like that's what you build a business for.
Yeah, no, that's absolutely right. I think it was an influential book for me was John Warlow's Built to Sell.
Mm-hmm.
Never read it. It was like, oh, and I actually owned a company at that point in time when I read that book. Gosh, going on a decade ago now. Maybe it was 13 years. No, yeah. Anyway, a while ago. And it was kind of the light bulb moment where it's like, oh wait, I'm building this so I can sell it. Like that's the point of it, is to build this to sell it, and then setting it up such that I could sell it was a great first move, and that was really influential for me. How you guys are kind of buying things that are maybe off the beaten path of other investors. Like a lot of people, if I hear Dallas Fort Worth multifamily syndicator again, it's like, okay, that's great. I know you guys are doing it and you're crushing it, but there's more markets than that. And you guys have found a unique way to get into some smaller niche markets, maybe that don't have the demographics that a Dallas Fort Worth might. How are you underwriting those in such a way that you feel like it makes sense, but then also not just justifying it, but then making those opportunities work?
So I love growing tertiary markets outside of, top 40 MSAs. That's what I love. Where the people live, where the growth is generally happening is, where you can really jump in and make a big splash is in those municipalities that are, 50 to 100,000. That is where I find you can still buy assets directly from the original owner, where you can go find a mom and pop sitting in the office, chain smoking Marlboros. Maybe not them, but somebody. I've seen it before.
Sure.
I haven't bought one from one of those yet, but you see it all the time in these smaller markets.
Mm-hmm.
You do have to plan accordingly for your exit, though. You have to determine who your future buyer is ahead of time and how are they taking out debt? What is their most likely level of, spread between rate and cap rate that they're willing to, adhere to or apply the purchase towards. And we increase that spread. So normally the spread is 100 basis points. sometimes in a major MSA like Dallas or Atlanta that's growing or whatever, it might be more like 75. So if you've got 5% debt, you can buy a deal that's a 5.75 cap, whatever. So ours is spread a little bit wider. It's more like 150 basis point spread. So if we are buying it, we believe that and debt is going to be 5.5. We plan for a 7 cap exit, and if we do better, that's great. But we generally also look for below institutional size investment properties, but also above, your standard mom and pop. So we only look generally for 100 plus. Occasionally we'll make a small exception, like on this current, future one that's just below by about 5 or 6 units, whatever. But I've tried to do it with the 70 unit. I've tried to do it with the 76 unit. I've tried to do it with the 38 unit, and it just doesn't work. So you got to go 100 plus or compile multiple assets. And we like, county seat, diverse economy, in, areas that are a little bit more landlord friendly as well. So,
Yeah,
yeah.
absolutely. Now, have you guys built, since you have a history in property management, are you guys vertically integrated?
No. So we rely on third party professional management groups to be able to jump in and run the day-to-day aspect of the asset, well, and execute our business plan. My role is putting together deals, finding and creating relationships with investors, and then asset managing the deal, and then executing the business plan, making sure that we are, putting the roofs on properly with the right contractor, make sure that all of that is done. Management is a very low margin business. Our management company that recently took over the 138 unit earns 3.5% of the gross monthly. 3.5% of the gross.
Okay.
Yep. I mean, that's after all expenses and everything, and that is directly their full profit margin or whatever. But when you add it all up, that one property, that 3.5%, it barely equates to a full-time salary level of income for that company in profit. But you essentially you have to have scale. You have to have, 40 projects that you manage in order to have it make sense. Personally. Right. Yeah. So theoretically one day, but I don't know. I'd rather build a brokerage business, because quite honestly, the profit margins on brokerage are much, much greater, brokerage or construction or, whatever.
That makes a lot of sense. Thanks for taking the time to break that down for us. Tell me, what are some things from your experience in property management maybe that you look for that other people maybe would not?
They need to have direct experience in managing perfectly similar assets in the exact same market. So if I'm looking for someone to manage my 138 unit in Arkansas, they need to already be managing 100 plus apartment complexes within a 45-minute radius of that exact property. Has to, because the last thing you want is to bring somebody in who has to create all new relationships with service providers, whatever, staffing. That's the bottom line with management. It literally all comes down to who are the people, the boots on the ground people, making sure to execute the top of the funnel business plan, and how well are they trained, and how well are they managed, and how much, how often are they, increasing the amount of training and expectations and all of that. How professional are they? Are they college grad type people? Are they AC certified people? Or are they just some guy with a rusty pickup truck and some person who has a residential real estate agent license? Like, I don't know.
Understood. No, I think that's incredibly helpful. Have you ever had trouble finding a management company that met your criteria?
Oh, absolutely. And in that case, I won't go into the market. If I don't have a management company identified who's ready to take over an asset in that township or municipality or location, then we just don't. That's the most important the most important part of the business plan. It's not, can I get the money from the investors? Is it in Texas? Like, not every part of Texas is good, by the way. Just to let you know, there are some really bad places in Texas to invest your money,
Absolutely.
that aren't very far outside of Dallas or Houston or Austin. Like, good luck. So, it's just, so long story short, the manager, if you don't have that lined up and you don't have a qualified manager, then we don't go there. We'll just pass on the deal. But usually that's part of the process in establishing the markets that we look for deals is, do we already have a manager there ready to go?
Yeah, that's awesome. And would you recommend that to somebody that's kind of where they start? Is
Always build your team, not just of your, like your like sponsorship group, but all of your subcontractors, your insurance broker, your property manager, your loan broker. Make sure that you have someone who is lined up, ready to go, experienced in doing stuff, and who is ready to go to that property or knows how to do it already. And also a team who qualifies too. Build your team based upon the types of deals you want to do, or limit the deals you choose to look at to the deals you can take down or have experience doing.
I think that's great. That's great advice. Hey, when you rewind your investing career, what's one thing you feel like you've done really well that other people should emulate?
One thing I've done really well, you know, I I have done my best to create connected personal relationships with my management staff, with my partners, with the subcontractors that I work with. This isn't just business. It is, real estate is not, Monday through Friday, 9 to 5. You
Mm.
get to know people on the evenings and the weekends, and in the early mornings before the sun has come up. And that's when you get the extra mile out of people, and with people, they want to see that you are willing to do it. I literally was the guy at my very first decent sized property, picking needles out of the bushes with my, well, not bare hands. I was wearing gloves, but that's just the type of property that I started with. I started with a D that I turned into a C. And, it started with cleaning out the landscaping and getting rid of all of the needles and the Band-Aids.
Yeah. Yeah,
Yeah.
absolutely. Absolutely, man. It's getting your reps in. You've got to get your reps in, and that's kudos to you for pressing on and getting beyond that stage, and then finding, of course, now your guys' niche and the criteria that you've really developed. It sounds through a lot of experience, the criteria that you use to buy, and just how you've worked with property management. You've shared so much with us here today, just on your investing journey. That's been super insightful. Thank you for taking the time to do that, Lee. This has been an absolute blast. Thanks again for coming on the show here today. Last question for you is this: if our listeners want to get in touch with you or learn more about you, what is the best way to do that?
The best way is I'm on my website. It's greenforestcapital.com. You can also find me on Facebook. There aren't many Fjords, Lee Fjord, Fjord out there. You literally type that in, and pretty sure I'm the only one that I know of. So find me on Facebook, send me a message. I personally know all of our investors. They have my cell phone number. We love partnering with people who are not interested in being a landlord driving around town in a rusty pickup truck with a weed whacker in the back. Your time is better spent allowing and working with other people who have already made the mistakes, been there, done that, and can help you avoid those things. I wish somebody would help me avoid them, but instead I just became the guy who learn from my mistakes.
Absolutely. And we'll make sure we include that there also in the show notes. Lee, thank you again for taking the time to come on the show today. I certainly appreciate it.
Thank you.